Hello and welcome to this conversation with Enrico Ganter and Justus van der Spuy. They are executive directors at Capital Energy Resources. Gentlemen, thank you both for your time today.
Pleasure. Morning, Michael.
A little background to our conversation. I'm not going to profess to be an expert at all on the subject today, so I'm in your hands, and as is the community who is watching this, to give us as much background and sort of the reasons behind a recent announcement and maybe some of the history of in relation to South Africa's strategic crude oil reserves. At the end of March, the finance minister, Enoch Godongwana, announced that as a way to mitigate the rising costs of fuel in the country, that South African government, Treasury, and the Department of Mineral Resources and Energy would cut the general fuel levy by R1.50 in April and in May. And that would leave a 6 billion rand hole, if you will, that needed to be filled. And he announced in Parliament that that money would be recouped through a sale of strategic crude oil reserves held by the Strategic Fuel Fund. Let's just start very basically, Justus. What is a strategic crude oil reserve and how big is South Africa's?
Strategic petroleum reserves came about in response to the oil shocks of the 1970s and 80s. So, this has been as a concept, it's been around for a long time, and it's motivated primarily by consumer countries holding obligatory stocks of oil, not just crude oil, but also refined petroleum products, to basically insure against a repeat of such events. And in the 50 years since, there have been events from hurricanes to wars, and of course, lately we have the events in Ukraine. And so, countries who feel themselves vulnerable to primarily physical supply shocks, i.e., not being able to get oil, built a policy framework, which, as I say, started in the 70s. It's really led by the International Energy Agency. And in brief, countries try, mostly OECD countries and those who can afford it, hold 90 days of net imports of petroleum products, be that crude or refined products, as a strategic reserve. South Africa, in the early 90s, had an enormous strategic petroleum reserve, of course, in response to the apartheid years and sanctions and fears of the country's rulers at that time of being cut off oil supply. So South Africa in those days had approximately 125 million barrels of crude oil stored in Saldanha Bay and in the coal mines in Ogies and these sort of places. But that strategic crude oil reserve was reduced down to today's approximately 10 million barrels, which are held in Saldanha Bay.
Okay, so if the South African government wants to recoup 6 billion rand, at do you sell it at the current price of Brent crude, which is, I don't know, hovering around 100? How do you determine? You've said that there are different grades. We were chatting offline, different grades. I don't want to get too technical, but would it generally sell for $100 per barrel?
Yeah, I mean today Brent this morning is trading at $109 a barrel, but we obviously live in extraordinarily volatile pricing times at the moment. So in an order of magnitude, yes, grades of oil all vary in terms of their price relationship to Brent. But $100 to $105 a barrel might be a range of pricing that you would achieve today, if you were to sell the oil for delivery today, of course. Yeah.
How risky a move is this? And once again, when we were chatting, you very kindly reached out to me and painted two scenarios, two approaches. What is and Enrico, feel free to jump in if you'd like to. What is the Capital Energy Resources best approach, best scenario that you would advocate for here? We got a $6 billion hole to fill. What is the best way to go about this?
So first, let me say that strategic petroleum reserve management is something which rather uniquely we have practiced for 30 years with governments. And I think I always say we're the only company in the universe who has a brochure about it. But what you do, there isn't any particular rule. It's not unusual that in these times of extraordinarily high prices, as well as a healthy element of physical disruption of crude oil supplies and refined products, mainly from Russia, that governments worldwide are in various different ways deploying strategic petroleum reserves to minimize the pain. And so in looking at ways in which to address this pain, South Africa is not unusual. Um, it's really what you do in response to the pain that you're trying to relieve. And of course, that's where we start looking at each country's unique capabilities and resources. If you are the USA with 600 million barrels plus in your strategic petroleum reserve, you have different means, as well as, of course, the fact that the USA today is actually a net exporter of liquid energy fuels or liquid fuels. Whereas South Africa, of course, is a net importer. So you have different means, and South Africa has quite a small strategic petroleum reserve. So you really are faced with two primary options. One is simply to net sell some of your strategic petroleum reserve and raise the 6 billion rand, which would be approximately 3.5-4 million barrels of oil today. But then the question you face as South Africa is you will then only have 5 or 6 million barrels left. And do you intend to replace those barrels in the future? And by selling them today and hoping, if your plan is to replace them one day, at what price? Will prices go ever higher? Will the conflict in Ukraine and with Russia continue? So that is speculative unless you are happy to simply net reduce your oil and you make that decision and that's klar. But the only other alternative that we would promote is what most governments are doing in the situation, which is a so-called oil swap. And how that I don't want to bore you with a technical speech about this, but ultimately in today's world, oil prices for current delivery, as we said earlier, Brent is hovering at around $109 now. And if you look ahead 1 year, if you were to contract for delivery of Brent 1 year hence, but do that today, you would secure a price approximately $14 a barrel below today's price. So the implication is, if you assume that you had Brent in South Africa's strategic stockpile, just to keep it easy, is that you would be able to sell oil at $109 a barrel today and simultaneously repurchase that oil for delivery 12 months hence at a $14 a barrel discount to that price. So, of course, capturing a $14 a barrel discount by selling today and repurchasing immediately in the future gives you less money to play with, $14, as opposed to the $109 you get if you simply sell it. But that $14, in our experience, is only the beginning, because you could, of course, decide to continue deferring the replacement of the oil if this structure of the market that allows you to defer the replacement of that oil but gain additional discounts to do so were to continue. And there are also many circumstances in which you might be able to replace the oil earlier as the markets changed. So there are various ways of structuring a replacement in such a manner that you would capture more than $14 a barrel. And what it importantly does, it puts you back in a position of having what is already a relatively small strategic stockpile. You might have to live temporarily with a reduction of 5 or 6 million barrels. You're going to need to sell or swap more barrels to cover your 6 billion rand. But at least you know that you're in a position that you can safely and with a known benefit replace those barrels in the future. So those you either net sell or you swap and defer the replacement of the oil that you are in effect disposing of today.
And you're advocating for oil swap.
Indeed, not because the U.S. Strategic Petroleum Reserve I mentioned earlier. Although they are talking about an oil swap as well, they're releasing 1 million barrels a day for 6 months, and then the talk is about replacing it. In the case of the U.S., because they are a net exporter of liquid fuels today, which is not the position they were in 15 years ago, they could, of course, simply net sell the oil and not bother with replacing it. But South Africa is not in that position. And if they were to simply net sell the oil, there would be really an increased vulnerability to future supply disruptions and a future ability to deploy this asset in a manner by which it then reduces some of the current pain of high oil prices.
Is this a sign of the times? How often has the South African government made announcements like this or stepped into the breach to try and cushion the blow to the consumer. If you cast your mind back to 2015, 2016, both of you are aware of the entire sale of the planned entire sale of the strategic petroleum reserve then. Um, is it a risky move? Was it a very bad move back in 2015, 2016? You both have experience with this. If you'd like to just give that experience.
Um, yeah, I think this is a well publicized event. Of course, it's been in the courts, and unhappily so, I would say. Of course, at the time, the planned sale of the strategic stockpile then was concluded in a market where oil prices were slightly above $20 a barrel. So, first of all, in a situation like that, it doesn't really make sense to dispose of the asset, apart from the fact that the sale at that time didn't appear to be planned to address any energy related concern that South Africa had around oil prices, because, of course, the market was low. And in any event, what apparently had been presented to the minister at the time as an oil swap was simply not doable in a market where prompt prices were lower than future prices. So if you were going to swap oil, you would achieve a lower price today than what you would pay to replace it in the future. So it's that whole event was a bit of a mystery. It's unwound unhappily in the courts, and those contracts were cancelled, which is why South Africa today is fortunately in the position to have oil worth $109 a barrel, which it can actually deploy to offset the pain that we all feel from these high oil prices.
Is when the Ukraine-Russia war in earnest kicked off on the 24th of February,
Michael, I must
there
correct you
was
there. It's a special operation, isn't it? Or
yes, Putin might well be listening. So 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 there was a lot of fear. I want to speak a little bit about the oil and gas market. What is the state of the market? Has the market sort of factored in? Yes, there is a lot that the conflict is ongoing, but are you surprised that it hasn't jumped higher than 100 and 109? It went up. What was the base we were starting at prior to the conflict? What is the highest it has jumped to? And is the market factoring the conflict in?
um, markets always try their best to factor in aspects of a conflict of this nature, and of course, will it endure? How enduring will it be? Maybe stepping back to how strategic petroleum reserves came about in the first place. The oil shocks of the 70s and 80s, so the Arab oil embargo, the Iranian Revolution, these were relatively enduring events. But at the time, they took a bigger percentage of oil out of the international market than today's conflict. And oil, the production of oil was also more concentrated than it is today. In today's world, you have not just in oil. I think today we also talk about strategic energy reserve management, not just petroleum reserve management, because the prevalence of gas, the transportation and trading of liquefied natural gas, you have wind and solar and nuclear power all forming part of the energy picture. So the impact of oil and the fear and shock effect is lower, and of course the fear of physical disruption leading you with cars grinding to a halt in the street is also lower. You have many more countries and many more places in which oil is produced around the world. Make no mistake, Russia, at 10, 11 million barrels a day is huge. Alongside Saudi Arabia and America, we're talking about the three largest oil producers in the world. And Russia, of course, from a European perspective, is an enormous producer and supplier of gas, and sits on the world, probably, I believe, the world's largest gas reserves. But so it's a real feature, not just in oil, and then the real concern is gas, because gas is not as well developed in the sense of being able to store it as you could crude oil. It's relatively low cost to store crude oil. Refined petroleum products are more expensive to store, but of course, gas is the real concern. Prior to the conflict, you have to remind me the exact. I'd have to look up the exact price just before the conflict erupted. I believe it was in the mid 70s, but stand to correction. So, am I surprised that it's not gone higher? I think it's been all over the place, I suppose. And supply and demand factors suggest that $109 is where the current fear levels are manifested. The release of significant quantities of oil by the United States Strategic Petroleum Reserve and the other IEA countries obviously produces or provides a 1 to 1.5 million barrel per day softener to what might otherwise have been a really tight market. Um, how long will this endure? I think the real concern is that as Russian production shuts in, because those companies can no longer sell their oil, you can't just restart an oil field and run the level of production at the same level immediately. So it's even if the war ended tomorrow, um, to restore production levels of some of the Russian oil fields is going to take time. So we're heading for a longer term tight market and high oil prices generally. And therefore, you see that not only is current oil trading at $109, but all the way out into next year and the year beyond, you've still got above $80 a barrel for oil. So it reflects a longer term concern, albeit that the current prompt delivery market is much more expensive than the further forward market. It's all very high.
Is what's happening in China at the moment with the zero tolerance policy for any COVID cases and the resultant lockdowns, is that driving down demand for crude oil and energy products from one of the biggest markets in the world? And is that helping to keep to moderate that price?
Uh, yes, although demand did recover substantially from the deep COVID levels that we saw, during 2021 and 2020. I would say it will have an impact. It's probably primarily in air travel, so you'll see it in the jet fuel market, for example. Jet fuel is relatively cheap compared to the other refined petroleum products today. And so what we find a shortage of is diesel and gasoline, or relative shortage. We're also coming into the northern hemisphere's driving season, so gasoline demand increases. So I would say it's really jet fuel that has been harmed or hit most. Um, no doubt, the Chinese lockdowns will impact perceptions and actual demand, but it's not countrywide. Chinese industry is functioning. Import levels are up a lot from what they were a year ago. But yeah, no doubt it will have some impact. Difficult to quantify though.
The costs involved in maintaining a strategic petroleum reserve. And is there a difference to be made here, or a distinction to be made between what the minister calls the strategic crude oil reserves and you speak about a strategic petroleum reserve? Is there a difference between those two?
A strategic crude oil reserve is what South Africa has. So South Africa happens to keep its strategic petroleum reserve in the form of crude oil.
Of crude oil, okay.
I would say probably 60% of countries around the world who have any strategic petroleum reserve will hold crude oil reserves. Others will have refined petroleum products, but it's all petroleum, referred to as petroleum loosely.
How long can you store it? How much does it cost to store it, Justus? Is it an expensive fixed cost, or does it change?
This has been the subject of our activity for the past 30 years. So it depends on where you are, whether you're storing oil above ground, underground. As in South Africa, the Saldanha Bay storage tanks are underground. Um, yeah, you can store oil for a long time in the right conditions. Certain types of crude you will store successfully for a longer period than others, but generally speaking, there's no limit to how long you can store crude oil. Refined petroleum products are different, but South Africa doesn't have that problem because refined petroleum products will go off spec after a certain period of storage. So you always have to refresh them or have your petroleum reserves as part of an operating system where there's throughput. So in South Africa's case, you can essentially keep the oil there almost indefinitely. There's not a quality issue. The cost, it's these are costs that were committed 50 years ago by most governments who hold strategic petroleum reserves today. And so have they written off those costs? Ultimately, there's capital involved. And so you have to associate a cost with the amount of capital that's involved, not only in the oil that is stored there, the inventory, but the cost of building tanks, which are then held inoperative effectively for that single purpose of being an insurance policy. We, and of course, every government is going to be different in terms of its costs. If you're Japan and you're hollowing out granite mountains, lining them in stainless steel, and then storing oil, you talk of a very different cost to having an underground concrete tank in the case of South Africa, or above ground steel tanks in others. But we, years ago, came up with the concept of a generic government, if there is such a thing. And generally speaking, you can associate a 10% per annum cost with if you take the cost of the oil that's there at a price of $50 a barrel. Today it's of course $100 a barrel. So again, you know, the opportunity cost of that inventory at $100 a barrel at today's interest rates, and the fact that its future value is some 15 or 18% lower than today, you could say there is a 25% cost today. But over time, over 30, 40 years, the calculation we came up with was 10% per annum at $75 a barrel oil. So $7.50 per barrel per annum in forever. And that's an enormous, if you express that as an insurance cost or an insurance premium, and got an actuary involved in assessing the underlying risk of that asset being deployed for the purpose that it was intended, it's an extraordinary cost. And our humble view has always been that when the word is strategic is used, then deployment of capital in a sensible manner is a concept which departs the room. But everybody does it, and South Africa is not unique, of course, in that respect.
So I a question I asked earlier: how often have we released or sold our strategic petroleum reserve? Was it only in 2015, 2016, and on this particular occasion it is planned for? Is that, to your mind, in a democratic South Africa, does it happen quite often?
Well, democratic South Africa, let's say that defining line was 1994, right? Really, or
Yeah.
1992, 94. There was a planned reduction of the strategic stocks from approximately 1990 onwards. So all the coal mines that were inland and within the reach of the Sasol refinery, that oil was sold as a long-term planned exercise, and subject to correction, there might have been some, I would say, 70 million barrels of oil stored in the old coal mines, and that over a long period of time was disposed of to Sasol. So that was a regular ongoing process throughout the 90s until those mines were effectively emptied. In Saldanha Bay, there was a significant sale of strategic stocks in the, I would say, mid 1990s, which then reduced the oil that was there. I wouldn't need to go back on my records, but say from 40 million to the 10 million you see there today.
I see. Would you be in 10 million seems for a margin of error, or for events like this? Is 10 million sufficient? It seems insufficient.
This is the problem when you talk about an insurance policy. What is sufficient? And of course, the answer there is that everybody's risk is different and everybody's exposure is different. So if Turkey, which doesn't have any meaningful own oil production, but if you sit at the crossroads of the world's oil trade and pipelines, you have a very different strategic risk than, say, South Africa, which has no real oil production to speak of, and imports all its oil. To put it in perspective, South Africa is approximately a million barrel a day market in terms of crude oil, refining, product imports, and so on. And so 10 million barrels a day, 10 million barrels of oil is roughly 10 days worth of import. So it is low compared to the 90 days ideal, which the International Energy Agency sets. Although we were the first ones to say that 90 days also is kind of crazy.
Oh, I see. Okay, so yeah, all right. So the law the overall picture you want somebody watching this on YouTube, watching this on our TV channel, to go away with: National Treasury, the DMRE, they've made this announcement. Um, it it was done to help the South African consumer at the pump. Um, and is this to be applauded? And are there indications we're going about this the right way?
Enrico, I don't know if you maybe want to give a few views on this.
Sure. Let me say that anything that governments do to help mitigate higher energy prices is to be applauded. But at the end of the day, we have to look at each country specifically, because every country has different circumstances, different assets at their disposal in order to achieve these aims. If you look at the current announcement, the current plan to sell off strategic stocks, basically, they'd sell almost 40% of the stocks to subsidize 2 months worth of fuel levy. And, so you've got to question whether this is a sustainable model at all. If it goes on for another 2 months, that's it. We've got no strategic stock and there's no money left to do anything else. So I think generally, to come back to some of the questions you were asking, Justus, about the cost of holding stocks and, how often does South Africa trade these stocks, or for that matter, other agencies that hold strategic stocks. I think what we generally advocate is kind of a proactive management of these assets, and your asset is either the tank storage, the tankage, the facilities, or the hydrocarbons that are being stored. And, so at different times, depending on the market structure, you'll have different strategies for basically trying to reduce the overall cost of holding the stocks. And at times, you can actually release cash. And with the market in backwardation as it is today, we have the opportunity in South Africa to release cash, but still maintain your strategic stocks. So I think, while it is it's great that the government is doing something, we would rather have a proper discussion around the sustainability of what they're doing in terms of an outright sale versus, what they call a stock rotation or time swap or whatever word they want to use for it. It doesn't raise as much money immediately, but at least you have the opportunity to continuously try and raise money as and when the market works in your favor. And we just think that that's just a much more sustainable model for reducing the cost of holding the stock, but also then releasing cash when you need it.
Enrico, you mentioned a backwardation. What on earth is that?
I'll let Justus explain backwardation and contango, because it is important, because at the time that the stocks were sold in 2015-16, the market was in contango. And I think people need to understand that the market structure was fundamentally different in 2015-16 when it was sold versus now. And, strangely, in 2015-16, they sold the stocks, claiming it was a stock rotation, whereas what we're saying is today, when the market's in backwardation, is when you should be doing the stock rotation, not then.
So the contango and backwardation
yes,
are the samba and the waltz of the oil markets. And a contango market is simply a market where today's price of oil is below next month's price of oil. Not where it will be next month. If you trade foreign exchange, you'll know that if you buy your dollars to go on holiday for delivery next week, or you want to buy your dollars now, but to be delivered to you in 6 months' time when you go on holiday, you will have different exchange rates. And so too with oil. You have a current and a forward price for all commodities, crude oil, refined petroleum products, etc. And the contango market is one that when you look into the future, you're looking up a hill at prices. So you'll go from $50 to $60 or whatever as future prices. So delivery for tomorrow will be $50 and delivery a year from now might be 60. That's contango. And what you do in a contango market when you are SFF, Enrico alluded to the management of strategic petroleum reserves to reduce the cost. So, of course, in a situation where future prices are higher than today, you can buy that oil today, put it into storage, but immediately hedge or fix the future price at 60, as long as that $10 gain that you make is greater than your cost of storage fees and financing the oil. That's a contango market. And of course, the asset which the government is optimizing in that scenario is the storage asset. So if you have, as SFF does in Saldanha Bay, 42 million barrels of oil storage, it's an enormous opportunity to earn storage fees. And that storage fee is an earning that you derive off the underlying strategic petroleum reserve asset. Of course, if you are occupying some of that storage with your own strategic petroleum reserves, you can, of course, only optimize or rent out the balance. In a backwardated market, you are standing on top of the hill and looking down the slope at future oil prices. So today's price is 109. 12 months out is $14 below that. And in that situation, your asset with the relatively high value is the oil inventory. And you kind of say to yourself, well, golly, if I don't need all of that oil today, let's play it safe and keep some for in case the pawpaw hits the fan. But ultimately, if I can release some of that oil today at 109, but immediately fix the price at which I get it back a year from now at $14 less, I've gained $14 plus interest on that money, etc. And I've also gained the opportunity to decide whether what I want to put back into my strategic storage in the future is the same grade of oil, or whether I defer that delivery in the future because the market continues to be on a downward forward trajectory. So that's the essential contango and backwardation. And of course, the process. So in a contango market, the asset you're optimizing is the storage. And in a backwardation market, the asset that you're optimizing is the inventory. And oil markets flick between these two. And that seesaw action between being at the top of the hill or looking up the slope is an opportunity for a government to manage its strategic petroleum reserves, something which, for example, the South Koreans do really, really well, such that their strategic petroleum reserves, I would say, cost them absolutely zero to maintain.
As you say, the waltz and tango. A final question from my side, and then I'll ask you if there are any other points that you think are really valid that people need to know about. But Justus, you've said Brent crude's at 109 a barrel today. If the war continues, and it continues for, well, we don't know, but if it continues for the rest of 2022, how badly affected is that oil price going to be? And I'm asking you to look into a crystal ball here, and I'd like Enrico to also give me his estimate here.
I'll take a stab at it because it is crystal ball, and I think Justus and I have been in this industry long enough to know that you'll never get it right. So, but your questions earlier about what happens with oil price, the war going on. There are lots of other things going on. There's been a groundswell of anti-oil sentiment, which over the last few years has reduced production. I think China, with their new zero tolerance on COVID, has dampened. But and the release of crude oil certainly had an impact on prices, because the market saw oil coming onto the market. But ultimately, what that also means is that the strategic stocks around the world are also reducing, and you can see that people record this, and you can see that stocks overall have reduced. I think the one big thing that hasn't happened yet, because a lot of governments sanctioned Russian crude and Russian petroleum products, but a lot of those countries that sanctioned the crude were countries that weren't really dependent on Russian crude or Russian refined products. So the key one, and I think it's actually being discussed at the moment in Europe, I mean, there's some key European countries that could change their position on sanctions, and that'll have a very significant impact on Russian supply, where it goes to, and crude oil markets. So I think that's kind of a big unknown. And the other, I guess, unknown is a lot of the Russian crude, although it's been discounted heavily. I think the last number I saw was something like $30 a barrel discounts. It's finding a home in countries like India. And so one doesn't know at some point, if there's enough pressure on India to close that outlet, what will happen, because oil has found another home. It's just at a much lower price. So we'll see. There's still some very big unknowns in terms of the oil price.
Justus, stab in the dark?
No, but he hasn't. Enrico's ducked the issue. He hasn't given a number.
He didn't give me a number.
If I knew that number, I wouldn't be sitting here talking to you guys.
We've known oil and oil and geopolitics and the related price of oil are, of course, are first cousins. And so the famous thing with oil, predicting oil prices, all other things being equal, what's going to happen? All I could say is that all other things being equal, whereas you're currently looking at oil prices 12 months hence being $14 a barrel lower than today, if nothing changes by the time you get there, the price of oil will be $109. So it's just as you look down this hill, as time passes and nothing changes, tomorrow's price becomes today's price, because that's the current environment for supply and demand. So I would say the reason oil prices, I believe, will remain above $85 for the next 12 to 18 months, at least, and that's the safest bet I can make, is this issue of, first of all, at certain high oil prices, you also have an element of demand declining. People drive less. There's an element of substitution. So it also kills demand when prices are this high. Also, don't forget the dollar is very strong. So one forgets the fact that in most people's currency terms, the oil price is even higher because of the strengthening of the dollar, the perception that interest rates are going to rise in the US at a faster pace than previously anticipated. So, of course, the dollar gains strength, and that, in a sense, is a disguised strengthening of the oil price in euro terms or rand terms, whatever you might want to look at. So I'd make a call above $85 because of that. And also, I think the comment I made earlier about the longer Russian oil is sanctioned or avoided, the greater the long-term impact on Russian production coming back to its historical levels. And that remains a significant absence from the market. We've also seen that OPEC countries apparently have been, the Saudis have been leaned upon to produce more oil, but I don't think they can produce that much more oil. And so spare production capacity around the world is a real issue. In the very long term, the prevailing feeling that you've got to hate oil to do the environment a favor also means that traditional sources of capital are no longer backing oil exploration and production. And so, that also feeds into a high oil price scenario for the future. And the final comment I'll make, if you ever really want to make money on speculating in the oil price, is ask me what I think and then do the opposite, and you'll make a fortune. So,
Enrico, final bite at the cherry? Anything you want to leave the viewer with?
I think higher energy prices, personally, I think are here to stay. And it's an interesting outlook at the moment with how do we transition to cleaner fuels in this process. There's all kinds of issues going on at the moment. In the UK, they're talking about taxing the oil companies, and these are the ones that are paying for the transition. So there are a lot of these things. Just one last point on the capital that goes into, the oil industry is not something that switches on and off very easily. And when Biden took office, he took a very strong stance against oil companies, and a stance which in the last few months is reversed because he's now trying to encourage people to produce more oil. But obviously, the industry is a little bit reluctant to just jump back in, because they need clarity in terms of legislation and things like that. So, interesting times ahead for all of us, I think.
Enrico Ganter and Justus van der Spuy from Capital Energy Resources. Thank you so much. A fascinating conversation. I've learned a lot. Hopefully, you who is watching this has as well. Gentlemen, thank you.